All right, welcome to Foundations Workshop Module 3. This one's going to be fairly short because there's a lot of supporting information for this. But essentially, what we're going to look at is randomness of pricing. And the basic idea here is that, yes, stocks prices may drift in a certain way over long periods of time, let's say over a year, 5 years, a decade. But within a certain time window, price movement is essentially random. We're going to look at 45 days within this course, and I'll tell you why 45 days is key in later modules. But let's just do some quick examples of price movement. So this will give us practice in Thinkorswim too. So let's go to Thinkorswim. Let's go to charts. If you don't have your watch list and your charts aligned, just do that quick here. You just want to match the numbers. So I got the colors. So I've got red to red matched here. So whenever I click an item in my watch list, it'll update my chart to show. So I'm just going to quickly do some just rough lines. This is 1 year of information. So let's start with SPY. I'm just going to kind of, it doesn't have to be perfect, this, okay. Let's just go like this. There we go, close enough. And then let's do something that's not reverse correlation, TLT. We'll do that with an orange line. And you don't necessarily need to remember the colors here. You may already have it in your head. Let's do that. And then let's just pick a stock off the top of my head. Let's go with GameStop, GME, GameStop. There we go. And let's make that yellow. Okay, perfect. And that was, I did a little bit of an aggressive align there, but you get the basic idea. Down, up. Okay, great. Now if I come up here and I delete out this underlying and just hit enter, it'll clear it out. So we got some rough, this sort of general upward movement of the red, general downward movement somewhat of the other ones. But it's choppy, right? It's up and down, it's all over the place. It's probably occurred to you already. Yes, there are drifts in directions of stock, but within that shorter time frame, the price movement can go any way you want. Not any way you want, that would be awesome. You just never know where it's going to go. The probability of it going up versus down is essentially equal. It's a 50-50 shot that a stock will go up or down on a given day. Okay, all that we've seen is over the 100 years or so that the market's in existence, that we've observed that about 53% of the time the market goes up. Okay, in general, so it's an upward drift to the market, but within that time frame, those shorter time frames, it's entirely random. This has been quantified in what's called the Black-Scholes model. Now, this is very heavy statistics. Not only is this beyond the scope of this course, it's beyond the scope of my understanding. These Black and Scholes, who are the two people that built this model, spent basically their entire professional lives building it. They won the Nobel Prize for it. But this is all you really need to understand, because the beauty of these trading platforms, it's all built in for you. But the basic idea, the idea behind the Black-Scholes model is that the options market, okay, allows us to quantify the market's expected move of a given stock. And it's quantified in terms of normal distribution. So you may or may not remember this from high school, but basically this is the example they always give. It's something along these lines. They'll say, okay, let's go out into the nation and we'll find every say 18-year-old or above male, and we'll measure their height. Okay, and we'll then quantify that statistically. We'll come up with an average, a mean. So let's say this line right here, let's just say the average is 5'10". I don't know what the average is. So we'll measure, this is the average of all the recorded data points, 5'10". And then let's say down here was the shortest person we observed was 3 feet. And I don't know, whatever, the tallest person is 8 feet. And then we'll plot on this chart here the observed measurements. So every dot would be an observed measurement, and it's going to look something along the lines of something like this, okay? And what we'll see in a normal distribution is that most of the observable data points fall around the mean. And then there's a kind of another section here, a little bit less, and there's a section out here. And these sections are referred to as standard deviations, and you can see it over here on this diagram. So about 68% of the observable items will fall within one standard deviation, 95% within two standard deviations, and almost every observable data point will fall within three standard deviations. These are just statistical terms, okay? We won't go into exactly what we mean, but it's essentially saying that a certain number of data points will fall within that. So you can split this up too. So you could say, it's 34% here, 34, and then this is about 15% in this area, and so on down the line. Now, this is how this is all quantified. Within a certain time frame, we can observe the movement of the stock. Now, let's put this into stock prices. So let me clear this out. Let me go back to Thinkorswim, and let's go with SPY. And if you go to the Trade tab, and let's open up closest to 45 days again. And let's look at the pricing. So we've got the current price is $235. And then on the option chain here, make sure you've got strike selected to all. So here's that $235, that strike. That's called at the money, ATM. On the put side, on the right-hand side, and we got call side on the left-hand side, any of the calls that are lower in price, the strike price is lower than the current at the money strike, are called out of the money, OTM. And then on the call side, it's just the reverse. So any calls that are above the current at the money price are OTM. And the nice thing is this is visualized for you on the platform. In the black is out of the money. On the blue is in the money, ITM. Okay. And you'll hear these referenced many times throughout the course. Now, 235, if we apply this to our normal distribution, then how this works within Black-Scholes is it says, okay, the norm point is the current stock price, 235. And then let's take a look at some items we can change here. So in these columns at the top, you should have delta already selected, okay, if you don't select it. Whatever the other one is, change that to probability ITM. So just select the top of the column, options, theoreticals, and Greeks, probability ITM, probability in the money. And this is saying, what the probability of this particular option being in the money. Well, let's look at the put side. If you remember, in the money means it is above the current at the money strike price. So what this is essentially saying is this option right here, this 13% option is 222. What this is quantifying is that there is a 13% chance that this at the money line will move from here to here. Okay, 13% chance. And then on the other side, probability in the money, we have a 12.57%. That's near enough. That is the 242. Is right here. Okay, so back to our normal distribution was 222 and 242. What it's saying is on the downside, one standard deviation 222, on the upside 242. Now you may notice right out of the gate this is not an equal distance, okay, and we'll talk about that a little bit in later items. It's based on the implied volatility, but this is how we build out our model. This is sort of what Black-Scholes is based upon. Now what this also allows us to do is quantify the probability of price movement. So we're saying there's a 13% chance of the stock based on this model and based on the implied volatility of the stock getting to this point within 40 days. So if I were to sell this option, I can say there is so it's 13%, so what's the reverse of that? 77% chance. Oop, I got that wrong. 87% chance, sorry, of me making $68. There is no other type of investment strategy that allows you to do this, to say, okay, there's this percentage chance of me getting to that point. And if you want, you can change it from probability ITM to probability out of the money, probably more useful. This tells you the percentages of you making your money. So with any given option on the board, probability out of the money, if I come to it and say, okay, this one right here, 72% probability of being out of the money, I can collect $1.50. So on this trade, I have a 72% chance of making $150. There's nothing else available like this, okay? Everything else is just a 50-50 shot. Stock goes up, stock goes down. Here I can quantify, and not only can I quantify, I can choose. I can say, well, this one is a 47% chance. So I can say there's a 47% chance of me making $330. The lower the chance, the more money you collect. Okay, that's the ebb and flow, and we'll look at that in more detail as we move along. But this is the basis of it, and this is how it's represented in the platform. Now, it's also represented by delta. I already talked to you, we've been selling these 30 delta options. A 30 delta option is about half a standard deviation. If we look here, probability in the money, 85%. If I change this back here for a moment to probability ITM, look, the percentage and the delta are very close to each other. So I just use delta, okay? You don't necessarily need to use these probabilities. They're close enough. Delta, in addition to being the percentage of the stock that you're representing, is also the probability of the stock getting to that price. So there's roughly, on a 13 delta option, roughly a 13% chance, a little higher. It's actually 14.45, but it's close enough, okay? Close enough. So you can just use the delta as a probability, which is really cool. So that's how this all works. Now, on some of the other platforms, for example, Tastyworks, if I go to the trade tab in Tastyworks, let me open up, I've got here Apple 40 days. Here's that 13 delta put, and then up here will be the 13 delta call, wherever it may be. Notice that here we got 15 delta, close enough. Let's say I were to sell the 13 delta put and the 15 delta call. Notice that there's a little dashed line by it. That is one standard deviation. They put it on here for you in Tastyworks. It's nice and easy because you can see the one standard deviation line. Okay, now lots of supporting data for this, but here's your activity here. Start selling one standard deviation puts and calls. 13 delta approximately. Start doing that and just sell lots of stuff. Use up all that fake money and we'll kind of move from there. Enjoy.